Something just happened in the Middle East that could quietly change the price of your fuel, your groceries, your investments, and maybe even your job prospects over the next few months. The United States has launched strikes tied to escalating pressure on Iran's infrastructure and shipping routes, especially around the Strait of Hormuz. And even though headlines make it sound like a distant geopolitical story, the reality is this: when a conflict touches global oil supply, it almost immediately touches your wallet. Right now, markets are reacting not just to the strikes themselves, but to what they signal. The Strait of Hormuz is one of the most important energy choke points on the planet. Roughly 1/5 of the world's oil flows through that narrow passage every single day. When tensions there rise, oil traders react within minutes, not weeks. That reaction then spreads outward into inflation, stock prices, interest rates, currencies, and investment sentiment worldwide. So what does this actually mean for your money? Let's break this down step by step in simple terms, because there are 3 layers to what's happening right now. There is the immediate market reaction, the medium-term economic impact, and then the long-term investment opportunity that most people completely miss when conflicts like this happen. First, the immediate reaction. Whenever military conflict threatens energy infrastructure or shipping routes in the Middle East, oil prices jump. They jump even if production hasn't actually stopped yet. That's because markets price risk before reality. Traders don't wait for shortages to appear. They react the moment shortages become possible. Analysts now expect oil prices to average between $80 and $90 per barrel this year because of the disruption risk tied to the conflict environment. And when oil rises, everything else follows. Transportation costs increase, manufacturing costs increase, food distribution costs increase, airlines raise ticket prices, logistics companies raise shipping fees, governments struggle to control inflation, central banks delay interest rate cuts. That entire chain reaction begins with just one event: instability in energy supply routes. Now here's where this becomes personal for investors. Higher oil prices often create winners and losers in the stock market. Energy companies typically benefit first. Oil producers, pipeline operators, and defense contractors tend to outperform during geopolitical uncertainty. At the same time, industries that rely heavily on cheap fuel, like airlines, shipping companies, and manufacturing exporters, often struggle in the short term. Historically, something else interesting happens too. Even though wars create market volatility, long-term stock performance after geopolitical shocks is often stronger than people expect. Over the past 75 years, major global shocks, including wars and crises, have often been followed by positive stock market performance within 12 months. So while headlines create fear, markets frequently create opportunity. The second layer of impact is inflation, and this is the one most people underestimate. Inflation doesn't just come from printing money. It also comes from supply shocks. When oil becomes expensive, the cost of moving goods increases everywhere at once. That ripple spreads across economies globally. Analysts already warn that energy disruptions connected to the Iran situation are raising inflation forecasts, while lowering economic growth expectations at the same time. That combination is dangerous. It creates what economists call a stagflation risk environment, where growth slows, but prices keep rising. When that happens, central banks face a difficult decision. Normally, they cut interest rates to support growth, but if inflation stays high, they can't do that easily. And when interest rates stay higher for longer, borrowing becomes more expensive for households, businesses, and governments, which means mortgages stay expensive, business loans stay expensive, startup funding slows, stock market momentum weakens temporarily. This is why conflicts in energy regions matter more than conflicts elsewhere. They directly shape monetary policy decisions around the world. Now, the third layer is what smart investors pay attention to most: safe haven assets. Whenever uncertainty rises, investors move money toward assets that feel stable during chaos. Historically, that includes gold, government bonds, and sometimes the US dollar. Defense stocks also often see increased interest because military spending tends to rise during extended conflicts. At the same time, technology stocks sometimes pause or move sideways because investors temporarily shift focus toward stability rather than growth risk. There's another critical factor here that most headlines are not explaining clearly enough. This conflict isn't just about military strikes. It's about shipping routes, specifically the Strait of Hormuz. If shipping there slows down even temporarily, Global supply chains tighten almost immediately. Some producers already face export constraints because storage fills up when shipments slow, creating pressure across petrochemical industries worldwide. That affects fertilizer prices, plastics manufacturing, transportation fuel, aviation fuel, even electricity generation in some countries, which means this situation doesn't stay regional. It becomes global very quickly. Now here's where things become even more interesting for investors watching closely. Markets don't react only to conflict. They react to expectations about how long the conflict lasts. There are basically three possible scenarios right now. The first scenario is a short escalation followed by diplomacy. In that case, oil prices spike temporarily and then fall back. Stock markets recover quickly, and volatility fades. The second scenario is a prolonged tension phase without full-scale war. In that case, oil stays elevated for months, inflation remains sticky, and interest rates stay higher longer than expected. The third scenario is the one investors worry about most. That's a disruption lasting long enough to reduce global growth significantly. In that case, markets rotate toward defensive sectors like utilities, healthcare, and government bonds while riskier assets struggle. Right now, the world appears to be somewhere between Scenario 1 and Scenario 2, especially with reports of temporary ceasefire efforts linked to negotiations around reopening the Strait of Hormuz. But uncertainty is still high. And uncertainty itself is what moves markets. So what should you actually do as an investor during a moment like this? First, avoid emotional decisions. Sudden geopolitical headlines often create the worst possible entry points for panic selling. Second, watch energy prices closely. Oil is the signal that tells you whether this situation is stabilizing or escalating. Third, pay attention to inflation expectations. If inflation forecasts rise again, central banks may delay interest rate cuts. That directly affects stock valuations. Fourth, consider diversification across sectors. Periods like this often reward balanced portfolios more than concentrated ones. And finally, remember something that experienced investors understand very well, but beginners often forget. Markets hate uncertainty, but they adapt quickly once uncertainty becomes predictable. Right now, investors around the world are not reacting just to bombs or threats. They are reacting to what those events mean for energy supply, inflation pressure, interest rates, and economic growth. So when you hear that the United States has struck Iran or threatened major infrastructure escalation, don't just think geopolitics. Think oil. Think inflation. Think interest rates. And most importantly, think about where capital flows next. Because money always moves before headlines explain why.